My name is Carlden Lainfiesta. I'm a mortgage broker. I've been in the industry for over 12 years, going on 13. Helped hundreds of people purchase and refinance homes. And today is seminars on home buying. It's scary, but it's really not. But I will tell you, after being a homeowner myself, there's almost no way around some of the concerns that we end up having when it comes time to buy a home. So we wanted to put together this workshop to kind of tie in some of the, debunk some myths as well as answer any questions you guys may have and introduce you to some of our programs or what have you. Beyond that, my colleague Dwayne Glenn, we're not sure if he has COVID this morning, but he couldn't join us, so he'll be out. But I would like to go ahead and Joanne, go ahead and introduce yourself.
Good morning. I'm Joanne Martinez, and I have about 25 years of experience. I'm great at challenging scenarios, including calculating and assisting with self-employed borrowers, investors, and first-time home buyers. I'm also bilingual in Spanish, so if you have any borrowers that speak Spanish, I'm here to help you. And I'm happy to be here today.
All right, so what is Monarch Mortgage? So before we go any further, we got to make sure you guys understand who you're potentially working with. Monarch Mortgage is a mortgage broker. We're located here in Los Angeles, California. We're approved to offer mortgages in California, Florida, Michigan, Nevada, and Texas. We are a wholesale lender, so we get wholesale rates. We're approved through 40 banks that can help our clients save over $9,000 on average instead of working with a direct lender. So me, myself, personally, I've worked with direct lenders most of my career. When I started Monarch Mortgage, my first concern was rates and speed. And I will tell you that making the switch has been great because our rates are better than direct lenders. Our speed is faster than direct lenders. And of course, our customer service is great because you get to work with both of us. So next slide is this is a team, okay? So it's not just me and Joanne. We also have two other team members that are not present on this slide, but we have our a whole team of people here willing to assist as well. And then jumping into programs, Joanne, can you talk to talk to everybody about our programs here?
Sure, we have multiple programs to offer. We offer FHA, VA, conventional, we have bank statement loans, 1099, W-2 only. We have DSCR, down payment assistance, as well as a bunch of other programs that we just don't have listed on this slideshow. How we help you win. So we have wholesale rates, as Carlden had already mentioned. We can close loans in 21 days or less. We have great customer service. We're very knowledgeable amongst all of us. I think we have more than 50 years of experience. We speak directly to listing agents to help sell your loan. We answer phone calls after hours and weekends. And so far, we have a 96% closing ratio, which is really great. On to you.
Yeah, just to let you guys know, the industry average is about 75%. When most people look to work with a mortgage company, the first place they think of is their major bank. Unfortunately, major banks have the worst close rate. So we'll often see real estate agents prefer either a mortgage broker or direct lender over a major bank. So your major banks being like your credit unions, your Wells Fargo's, your Bank of America, stuff like that. Now, the reason for that is because typically when you're working with a retail bank, most of those mortgage people, they're not required to do as much work as we are to make sure you're pre-approved. So for example, when we pre-approve a client, we look through your income, your assets, your credit, and we run something called DU, which is a desktop underwriting form. That desktop underwriter form is basically what says you actually are going to get the loan, right? So unfortunately, major banks, they don't run that until after you're in escrow. So by the time you enter escrow, you might quickly find out you're not approved. We don't work that way. We pre-approve you in advance, okay? So when you get a pre-approval letter from us, it's pretty much as good as gold. Really quick, this will let you guys know we're not just California. Florida, Michigan, Nevada, Texas. So for those of you who may be looking to relocate, we also can help you do that. So we can pre-approve you here. The money's good in any state we're approved in. So you can actually consider relocation if you would like to. By the way, I forgot to mention this. Feel free to ask any questions either through the chat or unmute yourself as we go through the presentation. Some stuff we may cover later. If so, we'll let you know. But we like to keep this interactive. So anybody who has questions, feel free to speak up and let us know. Okay. So what's scary about home buying? Before we actually get started with what we're about to present, Darlia or Spechel, do you guys have anything that scares you about home buying in particular?
I'll speak for myself. I'll potentially be a first-time home buyer, so obviously, whoever's assisting me would be my debt to income ratio, and then obviously the interest rates are what scares me the most.
Okay, okay, cool. Darlia, did you have anything?
I'll second that.
You'll second that. Okay. All right. So you guys will buy the same house together. We're just gonna know. All right. But no, those are two very good concerns, and we're actually going to address pretty much both of those. Debt to income ratio is kind of an individual thing, but we'll still talk a little bit about that as well. So, because here's one of the debt to income ratio problems. What's scary about home buying? Losing the home, can't make the payment. Another thing we're going to talk about, I don't want too many inquiries on my credit report. Home losing its value or market crash. I can't take care of the home, the maintenance, the payment, the property taxes, insurance going up. Can't afford the down payment. Kids won't maintain it. Major issues with the roof, plumbing, or structure. So let's start off by talking about I can't afford the payment being house poor, okay? So one of the things you guys should know, any mortgage that we do offer all types of mortgages. However, most of the mortgages that we offer, like I have not done an adjustable rate mortgage in probably 10 years. So, we are talking about fixed rate mortgages. What that basically means is your interest rate won't change, which means the principal and interest portion won't change, okay? So those are the type of mortgages we're looking to offer you guys if you decided to move forward with us. The other thing about affording the house payment, most people think about today. Unfortunately, we also have a future, right? So, or fortunately, I should say. So, the thing about the future is typically most people are making more money in the future than they're making today, okay? With the exception of when you get ready to retire, most of us on our jobs are going up by 3% per year if you're a W-2 employee. If you're self-employed, it might be a little bit different. But the thought is, over time, you typically make more money than you do today. Why does that matter? Because it's with the mortgage being pretty much fixed, and we'll talk a little bit about some of the things that can change in a mortgage, but with the majority of it being fixed and your income going up, it becomes more affordable over time, not less affordable, right? And also decreases in payment over time. So one of the blessings that we kind of have right now is that we already know today that the Federal Reserve is looking to lower interest rates over the next year. Okay, so that's something they've already announced and discussed with the general public to deal with inflation. They're looking to lower interest rates. What that means to us is anybody who buys a house today can be refinancing that house in about a year to lower rates even further. Now, I do suggest that that is the strategy that you use. Unfortunately, if rates go from right now, they're about 6.5% to about 5%, let's say, or 5.5%, you're going to see a lot more competition enter the market. Competition is actually kind of worse. It can kind of mess up everything for a lot of people because let's say that you have set aside, $20,000, but now you have competition that enters the market. So for the same house, because we're still in a limited inventory environment, you can have competition outbid you for that house. So if they have 25,000 or 30,000, they might be looking to put down more. Now, why would I say that? And why do I strongly feel that way? Because we've already seen it happen. We already saw when rates went down to 2-3%. I had a client that put $100,000 above asking price on a house during that time. So competition could then end up being the reason why you can't buy if you wait for rates to go down. So we recommend buying now. That way the price is cheaper and refinancing down to that lower rate in a year. Okay. So some of the other decreases in your payment over time. When you first purchase a house, if you're only putting down 3 to 5% or less than 20%, you're going to have something called mortgage insurance. Mortgage insurance is removable after you have 20% in equity on the house. So that'll be something that could be removed from your monthly payment to help make the payment more affordable. And let's just say you ran into some issues and you could not afford to make the payment as currently structured. Normally, after you get past at least 1 year with your servicer, the servicer is who you're making your monthly payments to every month, by the way. Once you get past a year, they typically will offer you something called a loan modification if it's necessary, right? So hopefully that's it's not that quick for us to end up there. But if you actually need it to have your payment lowered, you can actually talk to your servicer about doing so. Of course, it might ask you for some documentation to prove if your income has changed, if you lost your job. They're looking for different life events to make that happen. But it's definitely something that can happen for you if you run into some trouble making the payment. And then the last thing is property types. There is something called a starter home. And some people don't believe in that concept, but I think that that is very necessary in today's market when you're not seeing a whole lot of homes out here priced cheaply and all that kind of stuff. Does it make sense for you to go from a single family residence to a condo instead, or for you to purchase units instead of purchasing a condo, right? I've heard all kind of pushbacks to this concept. So I understand we all want what we want, but sometimes we don't want that payment or can't afford it right now. And there's still benefits to home buying, like appreciation, meaning the value going up of the home. So we have people buy a starter home, sell that home, or rent it out, and then buy another home to help basically get themselves going, right? So that concept is something that people run from, but we just want to make sure you know that's still a good thing to try to do, as well as purchasing units. And we'll talk a little bit more about that later. I don't want too many inquiries on my credit report. So one thing to let you guys know about mortgages is that the CFPB, Consumer Financial Protection Bureau, they actually allow a 45-day window for multiple credit checks to only be recorded as a single inquiry. So I'll say that one more time. So if you are going through multiple mortgage banks, okay, as long as they're a mortgage company, and they do a credit pull on you, from the first day of that credit pull, you have 45 days to run as many credit pulls as you like, and it will only count as one inquiry. To blow this portion up here, so the shopping around from a mortgage hurt my credit. No, within 45-day window, multiple credit checks from mortgage lenders are recorded on your credit report as a single inquiry. This is because lenders realize that you're only going to buy one home. You can shop around and get multiple pre-approvals and official loan estimates. The impact on your credit is the same no matter how many lenders you consult, as long as the last credit check is within 45 days of the first credit check. Even if a lender needs to check your credit after the 45-day window is over, shopping around is usually still worth it. The effect of an additional inquiry is small, while shopping around for the best deal can have you save a lot of money in the long run. Now, of course, we don't always want competition because we want you to work with us, but we also are not scared of competition, right? So to make sure you're getting the best rate and make sure you know you're getting the best rate. So just want to let you guys know that shopping around is allowed and it does not hurt your credit as much as people think. Home losing its value or market crash. What do you guys think? You guys think the market's gonna crash? I see Mike
not
shaking
too
his
sure.
head. Is this special? Am I saying that right?
Either one, special, but
Okay.
I'm not sure, not too sure on that
Okay.
question. Excuse me.
Okay. Well, you know what? We all don't have a crystal ball, right? We don't know what the future has in store. But one thing I wanted to point out to you is what has been happening in the market since the 1980s on this graph here. As you guys can see, since 1980, the values have been trending up. Now, on this graph, even though it's trending up, there are times when you see it trend down, right? It's not a straight line up. There are some times you'll see values dip, but overall trending up. And then when you get all the way over here to the peak, this is pretty much COVID right here. This is when everybody ran out and bought a house during the COVID epidemic or what have you. That situation created the lowest inventory environment that we've ever seen in the United States. When people were told they could not leave their home, basically they're like, okay, we need land. We need to move mom in. We need to work from home. We need to have our gym at the house. There are a lot of things that started to happen. People started moving, relocating, right? And we see the effects of that now is that there's not as many homes for sale as there historically has been. So now we see home values coming down a little bit. A part of that is also higher interest rates, right? During the pandemic, rates were 2-3%. They've gone up as high as almost 8% over the past year or two. Okay, so now they're starting to trend down. Now we've gone from to 6.5 approximately for conventional, about 5.5 for FHA. So we're starting to see rates slowly come down, and we're looking at per the Federal Bureau. Not investment, what am I saying? The Federal Reserve, excuse me, that they've announced that they're looking to lower interest rate another 25 basis, another up to 50 basis points by the end of this year, and another 100 basis points by the end of next year. That basically should lead to about a 0.75 decrease in rates, which would make the average rate closer to about 5.75% for conventional and 4.75 for FHA. Okay, so rates are going down. It's going to be beneficial to you guys if you're in this market. Next thing, I can't take care of the home. Joanne, can you talk to us about this? We can't take care of the home. What can we do?
So if you think you can't take care of the home, first of all, there's a home inspection, and a home inspection determines any issues with the property so you can request credits. Typically, the credits, the home inspection typically costs anywhere from $325 to $500. Now, you can also do a request for repairs. If home inspection or appraisal finds any issues with the property, you can request for a seller credit or for seller to repair or for a credit towards closing costs. So the seller can actually give you some monies. We put it into escrow for the closing costs for those repairs. Now, home warranty. A home warranty on average costs about $350 to $700. Now, this covers the systems, and the systems meaning heating, cooling, plumbing, and electrical. It can also cover appliances. Now, this home warranty plan can be as elaborate or as simple as you'd like. So you could pay a little bit more to have the home warranty cover some of your appliances. And now what happens there is that with a $75, it's on average about $75 service fee, they will come out and either fix and sometimes replace those units. And then last of all, there's also a handyman. Now, most realtors have referrals for someone who they can refer you to that might have lower costs in making repairs on properties. Back to you.
Yeah. Any questions about some of the stuff that we've covered so far? Don't forget this is an open invite. Throw it out there, okay? We're going to keep on moving along, though. The payment, property taxes, and insurance going up. So what made me kind of want to talk about this real quick is that I started to see some stuff on Instagram, somebody's, oh, my payment went up such and such amount of dollars. And honestly, I feel like they had a bad realtor or a bad lender. Because there's a lot of things that happen when you first purchase a home. So we're going to talk about that on this slide here, okay? So I already mentioned when you get a mortgage, your principal and interest. That's the portion of the loan where basically that's the loan itself that you're repaying. That is fixed for most part. If you're going through us, we want to make sure you have a fixed rate. Sometimes adjustable rates can be, you can try it, but chances are those things are set up to make you have to refinance. And if rates have gone up, you can end up losing your home. So we don't ever really suggest adjustable rates. So your principal interest should be fixed. We have property taxes. Now, when you first buy a house, I'm just going to use LA County as an example. You buy a house in LA County, the tax rate is typically 1.25%. Now, if you go to certain areas in LA County, like Compton has a higher tax rate, for example, then we have to kind of factor that in. Now, what typically happens when you first purchase a house, let's say you're purchasing a house for $500,000. And when you buy it, let's say it's today, October, that property is not scheduled to be reassessed until April. So when you first purchase your house, I myself and any good lender, they're going to make sure that your payment includes what the reassessment will be. Okay, a few things happen during this time frame. If, for example, we saw delays in reassessments during COVID. So in 2021, people didn't get reassessed till 2023, right? So the servicer who you make your monthly payments to, they gave back money to the borrowers like, hey, we can't hold on to this money for longer than 6 months by law. So they'll send the borrower back money. So we saw borrowers getting back $2,000 checks, $3,000 checks, and they're like, hey, thank you. And it's like, no, no, thank you. Okay. Like you can't spend that money because that money was allocated for your taxes once they got increased, right? So as soon as you get reassessed, the servicer comes back and say, you owe us $2,000 in taxes. To the average borrower, they're like, my taxes went up. Taxes didn't really go up. Your taxes were always based on 1.25% of the purchase price. It just took 6 months or a year or 2 years in some examples before you got reassessed. So if you ever get any money back from the bank, one thing I would tell you, reach out to me or reach out to your realtor or reach out to the bank themselves and ask them, hey, why did I get this money back, before you get too happy, because chances are they just didn't account for something that we accounted for in the beginning. Now that COVID's over, we're starting to see these reassessments happen quicker. So there's a less of a likelihood that could happen to you, but it still does exist. And just know that, so if, let's say that you are buying a house for somebody who bought the house at $300,000, their tax rate when they bought the house was at 1.25% as well, but that's still 1.25% of $300,000. So if you bought a house at $500,000 and you're at 1.25% of $500,000, the property has to be reassessed. Okay, and unfortunately, we have no control over when that happens, but it should not be an increase in your taxes. That should have always been what your taxes were scheduled to be. Insurance. So insurance is all over the place right now. We've had some insurance companies pull out of California. State Farm has pulled out because of wildfires. Now, I want to make sure that you guys are aware. I'm not sure about you, but I don't live in a wildfire area. I only have one tree on my property. So, it's not something that is, a real big deal for some of us that live in the cities. But obviously, if you live in certain areas, the mountains or what have you, you could be in danger of your whole entire house burning down. So one thing you have to consider is definitely the area of which you're purchasing, right? So you need a great realtor. Make sure they're not just dropping you off anywhere. For example, I hate to mention this, Mike, but I'm going to go ahead and talk about it. Michael had a family member. Me and Mike, by the way, if you guys don't know, have worked together for about, 10 years now, I would say. Well, maybe not 10. It feels like 10, maybe like 6. But had a family member who decided not to go with Michael, and he went with a different realtor. And that realtor put him in a house that was in a flood zone. And as soon as it rained, the first day it rained, the house got flooded. Your realtor should be looking out for you, not just looking to make a sale. And certain times, even though you might like the house, it might be beautiful, right? There are certain areas that are probably not worth buying into, especially if they're known to be a flood zone currently, right? Not to mention, of course, the future. So those are things we have to look out for. Coming back to the slide, excuse me. What I'm talking about is insurance in relation to this. Your insurance can be higher if it's in a flood zone. Your insurance could be higher if you're in the mountains. And if you're and because of all these life events that are happening, insurance has been going up across the board. So our recommendation for that is to be shopping around for insurance. And we have all different types of companies we partner with at Monarch. So you could end up with a company like Farmers or Mercury or something like that. They're kind of on on the upper side, but you have companies now like Bamboo and Lemonade that offer cheaper, low cost insurance. So those are things that that you have to consider. So your insurance costs can increase. Is something about your monthly payment. Insurance can go up. Mortgage insurance. So what that basically is if you're not putting down 20% on a house, the bank is going to require insurance to make sure that if you default on your payment, that they get back all of their money. Okay. So since you're at 20%, the reason why even to this day, some people believe that you still have to put down 20%, and that is not true. You could put down 3%. There's down payment assistance programs that'll allow you to put down as little as 1%, sometimes even $0, because you could get money refunded back to you. But in those events, typically you'll have to pay mortgage insurance. If you're going FHA, it's kind of a fixed number that we could calculate. If you're going conventional, it depends on how much you're putting down and your credit score, okay? But mortgage insurance is fixed, okay? That number does not change. Then you also have homeowners association dues that can increase. Now, HOA dues are only for like your condos and your PUDs. So a PUD is a planned unit development. So these are properties that have a HOA fee. HOA fees, they don't go away. So if you purchase a property, that HOA fee is going to be tied to it for the life of you living there. That's why condos are typically less expensive, because they have a HOA fee. Same thing with some of these PUDs. A PUD to the average person is probably like a townhome, okay? Is the best way to look at it, okay? So the recommendations. Ask your realtor, realtist, or lender about the property taxes and contact the city directly. So once you guys go into escrow, the first thing I would do, ask your lender, hey, can you tell me about the property taxes? How much is the property tax rate? We could give you the rate, but we can't really give you the insights to what all is tied into that rate, right? So if I say, hey, it's 1.15, but I won't know if they're scheduled to go up. So the recommendation is reach out to the city that you're purchasing in. Typically, believe it or not, these tax assessors, it's not a long hold. It's a quick call. Typically, you call them maybe 5 minutes. They're picking up the phone. Hey, yeah, what questions do you have? And the main question most of us want to know is are these taxes scheduled to go up, or what does our taxes look like? I'm in escrow right now, $500,000. I'm just using that number for an example, okay? So people purchase, millions. Some people purchase lower than that. But just as an example, you will want to ask them that question. We already talked about shopping around for homeowners insurance. And also, if you're purchasing a condo, contact the HOA about fees that are scheduled to increase, okay? Typically, the condo already knows, hey, next year we're raising our HOA dues. Or, hey, we've raised them and we don't plan on raising them again for another 10 years. Some condos already know that information, but I always would recommend doing those few things. Now, if you yourself are busy, your realtor could definitely do that on your behalf, but it's something that definitely should be done, okay? I can't afford the down payment. So let's talk about this real quick. We have a few programs that we're going to be talking about for down payment assistance today, okay? Some of them are local here in Los Angeles. Some of them are nationwide, including Los Angeles, okay? So this will help most of you get into your first house if you don't currently have the money. If you do, nothing's wrong with you putting down your down payment and closing costs. But if you don't, there are programs that can assist you, okay? So the first one we're going to talk about is the LA City's LIPA MIPA program. That's LIPA is short for low income purchase assistance. MIPA is moderate income purchase assistance. If you can see this slide that has this pink area of Los Angeles, believe it or not, that is considered the city of LA. So all of that pink is basically the city of Los Angeles. So the city of Los Angeles includes Tarzana, Encino, Northridge, right? It actually goes to San Pedro. And you see this like weird strip of land that goes down Wilmington, right? So the city of LA includes that. So what is not the city of LA? Inglewood is not the city of LA. Culver City is not the city of LA. Santa Monica is its own city. Beverly Hills is its own city. Everything else is pretty much the city of Los Angeles. Gardena, not the city of LA, right? So This program, though, if the property is located within the city of Los Angeles and you're under these income limits, so if you're one person is 77,000, for this is considered the low income program, you can get $161,000 towards your down payment if you're below that amount. And this is also by the family size. So if you have two people in your family, then you're up to 88,000. Three people, four people, so depending on the amount of people in your household, dictates what your income has to be below. Now, if you are above this, but below this number down here, you could get $115,000 towards your down payment. And then this last one here is $90,000 towards your down payment. Now, for this particular program, that money is not free. Okay, a lot of these programs that have put a lot of money down, they do require repayment. It's just a question of if that repayment works for you. The way LA City does it is it's a silent second. So that means there's no monthly payments required on the money they're giving you towards the down payment. The way that they get repaid is if you refinance for cash out or if you sell the property. What they'll look for, whatever percentage they gave you towards their down payment, let's say they gave you 20% down. When you go to sell the house, they want 20% of the appreciation. So let's say you bought the house for $500,000 and you're selling the house for $600,000. That means it went up $100,000. Okay, they want 20% of that 100,000. So that means they'll get $20,000 back plus the amount of money they lent you to purchase the house. Okay. So keep in mind, when people hear that, they're like, so they want 20% and they want 161,000. Well, keep in mind the loan you're paying on is $161,000 less than what you would have been paying on, right? So basically, you're going to be looking at keeping that 80,000 when you go through this scenario. Now, if you didn't put in any money for most part, because this program requires a 660 credit score and 1% of your own funds. So if the house is $500,000, you need $5,000 of your own funds. Okay. So if you basically put up, 1% to make $80,000 in this scenario, not a bad trade-off. Of course, you have to pay back the money that, they gave you, but you weren't paying on that portion of money while you owned the house anyway. So I've literally seen people save $1,000 per month going through this program because of the amount of money they're giving them. If it's over 20%, it also eliminates the mortgage insurance. So you're not paying mortgage insurance. In some cases, we could buy down the rate. All of those different things can lead to you having a significant savings and making the house more affordable for you. Before I continue, any questions about this particular program?
I have a quick question in regards to programs. So I'm currently doing I believe it's the HUD first time buyers program
Okay.
to obtain the certificate and everything. So does that still apply to this?
Yes, it does.
Okay.
Do you mind if I ask you who you're going through?
Operation Hope.
Operation Hope, okay. So you see right here on this flyer where it says first time home buyer and education. So you are a first time home buyer,
Okay.
and that education that you're taking is what they would need for you to get this to get these funds.
Got you.
Most of these down payment assistance programs do require first time home buyer education. So that is something that we can also. It's good that you're in that program, but we also have other programs that are online, sometimes in person as well, that you can also take. But yes, that can be used towards this program.
Got you. Thank you.
No problem. All right, the next one up. So the first one was the city of Los Angeles. This down payment assistance is for the county of Los Angeles, okay? So basically outside of the city of LA is where this program is supposed to be offered. So these pink areas in this slide is what's considered the county, as well as any city listed below here is considered to be a participating city, okay? So once again, it does have income limits. If you're below this income, then you get 100,000 or 85,000 towards your down payment and closing costs to purchase. Once again, it does have a minimum 1% borrower contribution. Okay. Now, if you're above these income limits, we do have other down payment assistance with higher income limits. Most of them don't offer as much money. They're not going to probably get 100,000. You might get the minimum towards down payment and closing costs, but they do exist. So Cal Haffa, for example, is one of the other programs we offer. We offer like 15 different down payment assistance programs. And one of them can go up as high as almost 300,000. So, depending on how much money you guys make, this program may or may not work for you. But just to let you know, we do have access to them. And then Joanne, talk to us about the next one, please.
Okay, so we have a zero down payment conventional loan, and this is more of a national loan. This loan is offered by Freddie Mac. The minimum FICO score on this would be a 620 with an area, you have to be within 80% of the area median income. Primary residence only is allowed. Single family, PUDs or condos. Home buyer education is required, and it's a 30-year fixed rate purchase. Now it features a second loan up to 3% of the down payment assistance. Maximum is 15,000. So up to 15,000 for down payment. There is no interest and no payment due. So it's basically a silent second. The loan is repayable, rather the second is repayable, which is for the down payment assistance that you're getting, will be repayable upon sale, refinance, or payoff of the first mortgage. This is available once again nationwide, and there is mortgage insurance attached to this. Now, one of the features on this is that, so let's say you're getting $15,000 for the 3% to put down on this program. You could possibly negotiate closing costs with the seller. So in doing so, that will minimize the amount of money out of pocket that you come in with. So let's say you can negotiate 3% with the seller for closing costs. You come in with almost nothing out of pocket. But one thing to always remember, as with all other programs, you always have to put in your own earnest money deposit, and you have to pay for the appraisal up front. So those funds do have to come out of pocket at the beginning. But like, let's say you negotiate something with the seller where they're going to pay, let's say, all of your closing costs, then you have the potential of possibly getting all of that earnest money back in your pocket. So yeah, that's the national product. Do you guys have any questions for me? Anything you'd like to add, Carlden?
Just to reiterate on that. So if this covers, and this program is really good for properties below $500,000, and the reason for that is that maximum of $15,000. If you take 500,000 multiply times 3%, that's $15,000. You can go above that amount, you could go above $500,000 purchase price, but you'll have to come in with a difference if the down payment is higher than $15,000. But if you're purchasing below, and this is a good one for relocation, if you're looking to go to Nevada, for example, this particular program, most houses out there are below 500,000, and you can get the down payment through this program for that purchase, right? And if the seller is willing to pay the closing costs, as Joanne was saying, then you're looking at zero down, zero closing. We are going to talk a little bit about the EMD shortly, but I just wanted to reiterate that. Any other questions about this particular program? And it can be used here too, okay? So you guys looking at a condo or something that could be used here in California. And then Joanne, we have the FHA 101.
Okay, so this is an FHA loan. It's an FHA 100% grant down payment assistance program. And the guidelines on this are 3.5% down payment assistance in the form of a grant. We have a 580 minimum credit score requirement on this one. Full doc is required. And then on this particular FHA product, you can only go up to 50% back-end ratio. Typically on FHA, you could go up to 57, but with this 100% grant program, you're capped at 50%, or rather 49.99, okay? This is allowed on single family, condos, PUDs, and up to a 2-unit, meaning a duplex. The requirements are, of course, primary residence only for first-time home buyers, or people that are less than 140% of the average median income, or retired, or people that volunteer. Non-occupant co-signers are allowed as well. So meaning a family member can help you They can help you qualify for the program and not have to live with you in the home. So that's what's called a non-occupant cosigner. So again, yes, 100% grant is also allowable on this FHA program, down payment assistance program. Carlton, what can you help me out here on what makes it, how you come up with the down payment on this? So it's 3.5% comes as in the form of assistance, right?
Yeah. So
And then
yeah, one of the things before I forget to mention this, then I can answer that question. The main qualification for this for most of you would be being a first-time home buyer. Because you're a first-time home buyer, you'll actually have no income limit. So even though it says less than 140% of the area median income, that's irrelevant to you if you're a first-time home buyer. You'll qualify for this program, and it doesn't matter about your income. Now, the down payment assistance portion of this, I believe it may be the next slide, so we're going to probably talk about this in a second. Whenever you guys are purchasing a house, you'll have to put down something called an earnest money deposit. That earnest money deposit is typically recommended to be 3% of the purchase price. The minimum is about 1% of the purchase price, okay? Now, that's technically a negotiable situation, right? So if you're buying, to use 500,000 to make the number simple, a $500,000 property, and that means that you will need anywhere between 5,000 and 15,000 as your earnest money deposit. Now that deposit goes towards your down payment, okay? Unless there's down payment assistance or there's like seller credits, and you can actually have that money refunded back to you, okay? But when you first open escrow, essentially the seller is saying, how much are you willing to put into escrow? So if you don't perform, or if you cancel, or if you take too long, they can start to try to keep your money. Real quick, shameless plug, Monarch Mortgage, myself, Carlden Lainfiesta, has never lost a borrower's EMD, okay? So what that basically means is that no one's ever lost money working with me, okay? So, of course, there's other things that happen. You may decide, hey, I've decided not to buy the property after an inspection. That's your decision, right? That's not like the loan didn't go through or anything like that. So just to let you know how that works. So we're going to talk a little bit more about the EMD shortly. This last slide I want to cover real quick because I do feel it's really important is some people may want to consider purchasing a multi-unit as their first property, okay? If you ever see a property that has like a duplex, a triplex, or fourplex, all of those are considered multi-unit, okay? The reason why I recommend them is because if you purchase a single family residence and you go to try to purchase a 2 or 3 unit property, you can put like 3% down or get down payment assistance for the single family residence. But when you go to purchase units, they're going to want 20% down because you're now considered an investor, right? You already own a property. They don't believe you're going to move from your single family into units at that point. So now you have to put 20 to 25% down, depending on the amount of units. If you did it the opposite way around and you purchased units first, you could put down as little as 5% and then turn back around and still potentially put down 5% on a single family residence or 3.5% if you're going FHA, okay? So basically, if you're looking to potentially own multiple units or properties, then purchasing the multifamily is probably the best bet. The other thing about a multifamily is that they come in different shapes and sizes, right? So you have, for example, you could have a side-by-side duplex where you share a wall, or you could have 2 or 3 different separate properties on the same lot, right? So you might see one house, then there's a house behind it, and there's a house behind that. That's considered a 3-unit property, but they have no connecting walls. So it's literally 3 separate structures. So this program, 5% down, came out about a year ago. Not a whole lot of people took advantage of it, but there's a lot of properties right now on the market that it makes sense. When you look at, okay, let's just say your mortgage is $7,000. Okay, that's scary. Yeah, $7,000. Okay, but if you have one house paying, let's say, $2,500. The second house is paying $2,500 as well. Your house is then left to pay $2,000, right? Which will probably be the cheapest payment you'll probably ever achieve. So the multifamily strategy makes a whole lot of sense. Of course, there's other things to it. You have to be willing to be a landlord. You have to be okay, with collecting payments or what have you. Somebody can miss a payment, right? But in most part, most people are not trying to be evicted. There's programs such as Section 8 where they pretty much guarantee you your money, things like that. So 5% down, 2 to 4 unit property. Yeah, it's a good program for those of you who are interested. So let's go ahead and move on. Keep the questions coming, of course, if you have any. But we're going to talk about this earnest money deposit a little bit more. So you first go to purchase a house. The money that you need to open escrow is considered the earnest money deposit. So as I mentioned before, it could be as little as 1%. So that money goes into escrow. Escrow is a company, by the way, that literally holds your money. You're not supposed to spend it, send it anywhere, do anything with it without both people's permission, your permission and the seller's permission. Okay. So it literally is a third party that just holds your money. Outside of that earnest money deposit, there's cost for an appraisal. The appraisal determines the value of the home. It could be anywhere between $500 and $800. If you're purchasing $1 million properties, it could be $1,000. Okay. If you're doing a home inspection, now home inspections are optional but strongly recommended because they tell you what's wrong with the property. So if there's certain things that you want fixed, in some cases, the lender, we may require certain things to be fixed. In other cases, there may be stuff that's cosmetic that you just want fixed before you purchase it. Whatever it may be, whether it's required or not, the home inspection is supposed to point it out to be like, okay, so hey, we see some chip paint here. Oh, we see the plumbing over here is not as great as it should be. Your realtor could then use that home inspection to negotiate with the seller and say, hey, listen, the plumbing on the property is completely bad. We got a quote that says it's going to take $10,000 to fix it. We either want a $10,000 credit or some money towards the repairs or for you to fix it before the house is even purchased. Right. So those are the types of benefits to the home inspection that can either help you get some money back or just identify what might be a problem. Condo docs. If you're purchasing a condo, there are documents that we need to order to make sure that the condo is approved. In some cases, if you're going to FHA, it has to be FHA approved. If you're going conventional, it has to be approved by Fannie Mae or Freddie Mac. So that type of documentation, their insurance information, their budget, if there's any litigation against the condo, that's the type of stuff that's being ordered. That fee is passed on to the borrower, right? So just kind of roughly guesstimating, this by itself could take you about $1,500, and it's not really refundable because the appraiser is a third party. So they're basically, that's their job. If they go out and appraise it, regardless if you buy it or not, they need to get paid for their service. Same thing with the home inspector, and the same thing with condo docs. So minimally, if you decide to cancel a transaction, you may be out this money if you decided to move forward but not go through with it. Okay. Any questions about this portion before we continue? Okay, what I heard is everybody got the money, no problem. All right, so so moving right along. Kids won't maintain it, keep up with the payments. All right, so what I wanted to incorporate here is this buy versus rent comparison, okay? So one thing that we looked at is if you were to purchase a house at 500,000, we use LA County for this example. But when you first buy a home, you have your down payment, your closing costs. So it's estimating that you'll be out of money. Like basically, you have to spend about excuse me. But it's estimated you have to spend about 28,000 towards your down payment and closing costs, right? So that's why this is in a negative here. So when you first purchase, you lost some money. As the house goes up in value, and we're using an appreciation rate of which is forecasted at 5.25%. Just to let you know, the actual is actually higher than this. Okay, I got somebody coming into the room late. You see our people? You see our people? Those kids coming on in. So just know the actual appreciation rate in LA County was closer to 7% this past year, okay? And is anticipated to at least be 5% next year. And so the forecasted is 5.25%. So what that basically is saying is that because you bought the house and it went up in value, now you're essentially, it kind of helped you recoup the cost of purchasing. The next year brought it to almost zero. And as you can see, if you go through 9 years between you paying down your mortgage and that house going up in value, you're anticipated to have a net gain of $187,000. Now, when it gives us this number, it even factors in the cost, because for you to get that money, you basically have to sell a property. So this actually factors in the cost of selling being about $39,000, right? So you could sell the property and still walk away with a net gain of $187,000 after 9 years. This is the power of real estate, right? And even though most of us are just looking to put a roof over our heads, it makes it hard to lose in this type of environment. We have low inventory. Why is that important? Because as long as inventory stays low, these prices are going to continue to go up. As you guys know, supply and demand, right? When we couldn't get crude oil, what happened to gasoline prices? They shot up, right? So like this is just an example to tie it into real estate. When there's not as much inventory, the price goes up. I'm not sure what kind of candy you guys like. This is Halloween season, right? Let's just say there was only one Snickers left on Earth. How much you think it would sell for? Some crazy person's gonna pay $1 billion for the last Snicker on Earth. You know what I mean? So like this type of stuff is just to give you the concept of supply and demand. And because supply is so low right now, home prices are forecasted to continue to go up for the foreseeable future. Kamala Harris, I'm not trying to get political, but she's talked about building millions of homes, right? 3 million homes or something like that. Of course, 3 million homes aren't going to be built overnight. This is still going to be our trajectory for the foreseeable future because 3 million homes are going to probably take 10 years before they get completed, right? So another thing I want to talk about here is the tax benefits over renting, which is being factored into this as well. So because you are purchasing a property and you get to write off a number of things, your mortgage insurance, your property taxes, your your mortgage insurance. No, sorry, I said that wrong. Your mortgage interest you get to write off, your property taxes, your homeowner's insurance. And if you have an investment property, you also can write off the depreciation. And that includes if you purchase a 2 to 4 unit property, because if you live in one, you get those write-offs, and the other unit is an investment. So you can write off depreciation for their side. So that's another reason why 2 to 4 units are pretty good to purchase. So between all of this, you're looking to win, not lose, basically by purchasing. And as you can see, pretty much at a 5.25% forecast. If you were to sell this property in about 2 to 3 years, or even here at the 4th year, you're not going to really be losing any money because you'd have to take that 5% of value that it went up, reinvest that into your agents or what have you to sell the property so that you wouldn't end up losing money. Okay. Any questions about this before we continue? And the reason, sorry, let me just say this before I go back. This is a part of that same slide, $500,000, okay? Because we're talking about the kids in this scenario, can't keep up with the payment. So this assumes that you're renting a house or even an apartment at this point, which even apartments are hard to find at $2,500. But you're renting for $2,500 right now in year 1. And then in this example, this total house payment could be $4,015, okay? As you look at this slide up here, and you see this kind of this first purple is pretty much the mortgage. This light purple is the example of you renting. As you can see, as time goes on, this purple is getting a little bit taller, right? And that's because rent can increase over time. Historically, about 3% per year. Some people have never seen a rent increase, but lately what we're starting to see is that either sellers, the owner of the property is starting to sell the property. When they sell the property, whoever lives there has to move. So we've seen rent increases that way. If you're in an apartment complex, they're pretty much always raising rent, you know, especially if they're owned by a corporate landlord. If you look closer to year 9, we start to see where rent is basically starting to be equivalent to owning. So when you look down here, you also see it's about a $900 difference, right? Of course, $900 is not nothing, but when you start to factor in the fact that number one, you have tax savings that have been occurring this entire time, right? You're really probably looking at a difference of like somewhere between 400 to 500 bucks after you factor in what you would get back in tax savings per year by being an owner instead of being a renter. Okay. Some of what we're also seeing when it comes to the kids is that if they can't afford to pay market rent right now, so let's just fast forward and say 10 years from now, they're going to start to take over whatever the house payment is that you had. Oh, by the way, because this number 4015 is based on a 6.5% interest rate, by the end of next year, we're anticipating to be able to refinance this rate down. So your payment can go down, right? So this 6.5% can end up being 5.5% or 5% or 4.5%, right? That's one of the benefits when you purchase a house, and you're only going to refinance if it makes sense, right? So if rates are lower than what you have now, you refinance the house, you drop your mortgage payment. Now that could extend out your loan term, but guess who that's good for? The kids, right? Because they can afford a lower mortgage payment. So if this payment goes from 4,000 to let's say 3,200, the kids benefit from that, right? So even when you look at a scenario like that, you might be at break even of what you would be paying in rent by buying a house and refinancing it to lower payment at year 9. Having a house is harder to lose than an apartment, right? If you miss your monthly payment on your rent, they're trying to get you out of there within a month or two, right? 3-day pay or quit, you know, you get that as soon as possible. When it comes to your mortgage, you're going to take 3 months before they send you a notice of default. Then it's going to take another 3 months after that before they actually start the eviction process. Okay, so it takes about 6 months to lose a house, and even throughout that process, most banks are trying to work with you, trying to modify your loan, trying to figure out how to make it affordable for you so you can keep the house. Okay, so now that I went through all of that, any questions about this so far? Does this sort of make sense? Because Special and Darlia, you guys both mentioned the payment being, or excuse me, really the rate, but the rate correlates to the payment as well, right? Being your concerns. And I think it's Natori, I believe. Welcome.
We can't hear you, Michael.
Oh, I
Oh,
said her name. Oh, you can hear me now? Her name is Natari.
Natori.
Yeah, Natari.
Natari, gotcha. All right. Well, anyway, this is something to consider. A lot of people try to kick the can down the road, but we see what happens when we do that, right? The house is going to go up in value if you kick the can down the road. I have another scenario here, 800,000, but I'm not going to, go through all of that if there wasn't any questions about the first one. And one of the things I wanted to show you guys, I'm gonna go forward to go back. Actually, I'm gonna go back to go forward.
Hello, everyone. Thank you. My microphone was on mute. This is Natori.
Hey, Natori, welcome.
Thank
Hi.
you.
As you guys can see, the trend of where houses are going, right? So when people ask me when it's a good time to buy, I tell them as soon as they qualify. Why? Because it's going to cost you more next year. So it'll cost you more year after that. Now the prices can start to come down, but what is that going to take? We saw rates go up as high as 8% and they barely came down. In our market, because keep in mind, this is a chart of homes in the United States. So when you start to break down individual markets like Los Angeles, we didn't really see a decrease in prices like that in Los Angeles. Las Vegas, same thing. Their prices are pretty much higher than they were the year before, the year before that. So if you can buy a house today, I would say buy it. If you don't love that house, sell it in 2 or 3 years because it is going to be worth more at that time, right? If you can rent it out and still, and that covers the mortgage, it makes sense for you to do that as well. If you don't like being a landlord, you can get a property management company. They'll take care of all of that stuff for you, just cut you the check, right? So Point being is buying now is better than later. Let's go back to where we left off real quick. Major issues with the roof, plumbing, or structure. Joanne, could you jump in for the segment?
So again, a home warranty plan can help you with issues such as roof, plumbing, and sometimes structure. Home warranty makes sure you include roof and plumbing coverage. So again, the home warranty plan you can make as elaborate or as simple as you'd like. You can add to it so that you can have some of that roof coverage, so that you can have some of the plumbing coverage, so that you can have the heating and the heating and cooling systems covered. It can also cover, again, large appliances in your home. And that means that with that $75 or $50 service fee, they can either come out and fix it or possibly even replace it at times, okay? Now, as far as insurance, homeowners insurance can be used to repair plumbing issues. And earthquake or flood insurance is also available at times, but your homeowner's insurance is going to help you with those things that might happen to your home after some type of a disaster, let's say, or fire. So homeowners insurance will cover you for any fire. If you make it a more elaborate plan, it can also help you for theft. If you're in a flood area, you can also add to it flood insurance. And at times earthquake, if you want to pay the extra, earthquake insurance can also secure you with that. Structure. Retrofit is recommended to help bolt the structure to the foundation. Again, these are the type of things, especially the structural type of things, can be called out when you get that home inspection done at the very beginning of the process. That's why it's really important to get that home inspection done. The home inspector will go out there, he'll spend about an hour or more, give you basically a book of information on that property so that you know what you're getting into upfront.
And just a really quick piggyback on that. My first purchase, the first property I purchased was a duplex. When I got into escrow for this property and we had a home inspection done and it was determined there were some issues with the foundation. The first thought I was like, man, I'm about to cancel this transaction. There's issues with the foundation. Talk to the seller's agent, and we actually were able to negotiate $16,000 to repair the foundation. Okay, so what I ended up doing was getting that money back, finding a provider to fix the foundation. They actually charged me $14,000, so I actually made like $2,000 fixing the foundation, and it got it retrofitted. There was a part that was slumping. They had to pour concrete down there, so basically it made it so if an earthquake were to hit, that it's less likely to shake off of the foundation. So if you are in escrow, you notice certain things like that. Sometimes you gotta not every seller is going to give a credit. So I don't want to, make it seem like people are just giving away money out here. That's not the case, okay? But if it does make sense, like, hey, these damages exist, and this is a big deal, there's ways that we can negotiate to try to make sure that you end up with a good property at the end of your purchase. So this slide here, what should you be scared of? Rent increases over time.
Mm-hmm.
So one of the things that I look at is, man, I wish we all lived forever, right? Like, and that we didn't have to retire one day. Some of us don't, but what does rent look like 30 years from now or 40? I mean, I'm not sure how old everybody is here, but, how much time you believe you got. But, I think I might have 40 years in me. But I don't want to know where rent's going to be 40 years from now. We saw an example where, hey, it's close to what, rents 9 years from now will be close to what you purchasing today would be, right? Rents increasing over time is a big thing to homelessness, because when you get to retirement and your income is fixed, it's not going up, you're not working a job anymore. If you have large increases to your living expenses, it could lead to you being homeless. That's a danger, right? Or just having to move from one area to another. So a lot of people have been displaced over rents being increased, okay? We have probably 2 or 3 different clients looking for houses right now because their landlord said, hey, I'm selling the property. You guys basically need to move. The seller owes them money in some cases because it's like a no-fault eviction, but still, they got to go pay market rent now. If they would have bought a house 4 years ago, 3 years ago, of course, it would have made more sense, right? So rent increases over time, definitely scary, especially when you start thinking not like next year or 2 years from now. Think 20, 30 years from now. How much will your rent be? How much will your income be? Would you have been better off in a home by the time you got to retirement? I have one other quick story about that. I had a client, she's been in the house for about 15 years, hit retirement age. And she said, Carlden, I just want you to refinance this thing to make my payment as low as possible. So then that way, when I go onto my pension income and my Social Security, that I can still afford this house without an issue. So she took her $3,000. I mean, it was like this is a few years ago. She took her $3,000 mortgage and dropped it to almost like $1,800. And was just like, hey, I could just pay on that. I could afford that for the rest of my life. One thing about your rents, they'll always become due. You could pay off a house actually, right? But rents will always be due every single month. So when you start to get to retirement age, especially 20, 30 years from now, that becomes super dangerous for all of us. Next quick things, no equity, right? Just not having property at all means that you don't have, if you bought something at $500,000 today and it went up to $800,000 or $1 million, 10, 20 years from now, however long it took, right? That gives you the ability to pull cash out of your house, to use it for whatever you need it for. When we start talking about these millionaires and things like that, even Donald Trump, right? How did he get his millions? Real estate, right? Because he has buildings that he purchased and now they're worth millions of dollars more, and he's able to take out loans on those properties, buy other properties. This is how a lot of people are increasing their net worth, right? Which is actually the next slide. If you don't own a property, your net worth is going to be forecasted to be low. Which means how much are you worth, basically, right? Because you have the money that's in your bank account, however much money that is. The next thing that people are looking at is what assets you own, right? No rental income. So at some point, we all need to retire. If you have properties, you can make some rental income off of that property. Even today, the property that I purchased 5 years ago has now netted me $1,500 a month in rental income after expenses. So, that helps me wherever else I went next, right? Being displaced by your landlord, we kind of talked about that. It doesn't happen till it's happened. People don't fear it until it happens, right? Till you get that notice, oh my God, I should have bought, So I'm trying to get people to start thinking ahead because it's only logical as landlords don't live forever, right? Once a landlord passes, the family is looking to sell that house. So stuff like that. No tax deductions. For any of us making above $100,000, IRS, typically you owe them every single year. Every single year, $6,000, $5,000, whatever, $8,000, you owe them, right? So when you got to keep that in mind as well, owning a house, sometimes that stops the bleeding. So instead of you owing them $8,000, let's just say you owe nothing, right? But you're using that $400 you were paying them per month to go towards your new home, right? Makes more sense for you to invest that in your property than it is to give it to Uncle Sam. So yeah, tax deductions, very big deal. No generational wealth, right? So if you don't buy a property, what are you leaving to the kids? Can the kids even afford to purchase or do market rent? Will they ever be able to get ahead? It starts to become questionable in today's market. And of course, we talked about retiring and still paying rent, right? That's super scary. All right. So we're wrapping up a little bit here. These are our partners. You recognize one beautiful face here, Michael Allen. No Diddy, But Michael Allen here is one of our partners here in Southern California. If those of you who are interested in relocating, we have partners in Northern California, Nevada, Texas, right? We have partners in Michigan and Florida, but not too many people express interest there for the people that signed up or what we've come across. A lot of people are interested in Las Vegas. A lot of people are interested either in California or certain parts even of the Bay or Texas, right? So these are some of our partners here that we can refer you to if you guys need help with a mortgage. Not a mortgage, with your real estate needs if you're going out of state. Okay? If you're here in state, Michael Allen got you. But if you're going out of state, then we might have to refer you to somebody else. And this brings us to our question and answer segment. Thank God, because I'm out of my voice is getting hoarse. But any questions so far, things we didn't cover, things that, And please don't, there's no question that's a bad question. There's no stupid questions. This is when you should be asking questions, right? So any questions so far about anything we covered or maybe what we didn't cover?
Carlden, can you guys hear me?
Yeah, I
Okay,
think Darby
awesome.
just came off of mute though. I want to
Okay,
take
what
Darby.
about now? Well, I'm sorry, I got a little situation over here, but you can hear me now?
Yeah, yeah,
Okay, awesome, awesome. I don't have a question right now, but I do have a comment.
sure.
I just wanted to thank you and thank Joanne for putting on this wonderful presentation. I do believe, I know we had a lot more people that were supposed to sign up, but you know, the Dodgers won the first game last night. So I think a lot of people are still in bed and recovering from celebrations. So,
Yeah, absolutely. I learned a
so
long time ago, Mike, it's not about the numbers, it's about the quality, brother. So,
exactly.
one of my first seminars, I only had one attendee come. And guess what? We got that one attendee a house.
Exactly.
So then I was saying 100% of my attendees got a house because that one person got a house. And if there's one person, the show must go on, man.
Exactly, exactly. So to my point is you guys put on an amazing presentation for the people that we have here today. So I just want to thank you for extending the invitation to me to allow some wonderful people that's on. Actually, Natari and Darlia. I actually met Darlia a couple of days ago.
Oh,
So
wow.
so I'm glad that she was able to come on today. And then of course, Miss Special is actually one of the tenants in my building. So I hope they got some wonderful information. This was like a how do I say it? It was like it was great confirmation for me, you know, to be able to want to get even more people. So I look forward definitely to the next one. It was an amazing job, wonderful wealth of knowledge that was shared today. So thank you both.
Got you. Sorry, I just lost where I was on this slide.
I think Miss Lawrence Darlia wanted to say something or has a question.
I didn't have a question, but I did want to just thank you guys for your time and everything, because this is like a crash course on buying a home, and I really appreciate it. Michael, I have your number, so I will be contacting you in the future when I'm ready, but I really appreciate the insight today.
You're welcome.
Just a quick comment on that. And you're ready whenever you guys are, but these prices are not going to slow down. And if you happen to be, because I had a situation, I see it all, right? There are windows of time in my mind that people qualify for a house. Your income has to come together, your credit score. If you have money for your EMD or money, even if you're getting down payment assistance, you need money for that EMD, the property type that you're looking for, all of that stuff has to line up, right? So I had a woman who qualified for down payment assistance, contacted me after she got her promotion. Guess what? You're over the income limit now. Right? I mean, I'm laughing, but it wasn't funny to her, right? Like, you know, like, so she ended up having to look for another program. Most of these programs don't give her the amount of money.
Wow.
So just keep in mind that some of this stuff that's available now, and even when we look at, hey, COVID crisis, we saw banks. I remember Chase Bank came out and said, we're not taking any clients that's not putting 20% down with a 720 credit score, right? Most of us ain't got 20% down. You know, 20% down of even a $500,000 house is $100,000, right? So you have $100,000 to put into buying a house, right? So if this economy gets worse, you start to see down payment assistance programs go away or be put on hold, right? So take advantage of it while it's here, because you know none of us were ever ready. I was in escrow for a house. I was like, man, am I ready? I'm a real estate broker, mortgage broker. I was scared. Okay, we ain't ever ready. You know, is this something that we gotta take a stab at and start trying to figure out? Last thing I'll say on that: first step is the application. Right now on the screen we have the contact information. So this isn't, you know, an application. This is just to get our contact information into your phone. However, there is an apply now button down there if you decide you want to put in an application. Okay. So this is for me, Joanne. Joanne actually is listed as a loan processor here because she also does do some of the processing on our team, but she's also a loan officer in the state of Nevada that can help you guys get licensed out there. I mean, not licensed, help you purchase out there.
Purchase.
Excuse me. Oh, cool. Any other questions, comments? Well, I hope that we helped unscare you, or maybe we scared you a little bit more. But unfortunately, this is the environment that we're in. You know, it's a little scary out here. My biggest advice, like I said, take advantage of these programs while they're here, because if you wait, let's say even a year, the forecast next year, next summer, this upcoming summer, we're going to start to see more buyer activity than we saw this summer because rates are going to be lower this upcoming summer. When you see competition to me is worse than all of this stuff. The rates, I mean, we talk about what's your biggest obstacle to being able to buy. I can help people with their credit. I can't do nothing about your income, but I can help you with your down payment, right? So when you're using down payment assistance and or you don't have that much funds and somebody else has more money than you, that's the biggest obstacle to purchasing. So let's try to make it unscary. Feel free to reach out to me, Joanne, Michael Allen. And other than that, you guys have a great weekend and thank you for attending.
Thank you.
Thank you.
Thank you. Thank you. Thank you.
Thank you.
Thank you. Have a
Have a
good
good
weekend,
weekend,
guys.
everyone.
Thank you.